In 1950, every financial decision on Earth was made by a human being. A loan officer who looked you in the eye. A trader on a floor. A clerk stamping documents by hand. In 2026, most of those decisions are made by machines. And the machines are getting better. This is not a story about the future. This is a story about what is already happening, right now, inside the system. Your entire financial life depends on. And most people have absolutely no idea. In this video I am going to walk you through exactly how AI is replacing the 4 pillars of the global financial system. What is already gone? What is being replaced right now? And what this shift means for your money. No jargon. No hype. Just the clearest explanation of the biggest structural change in finance since the internet was invented. Before we talk about what is replacing the financial system, you need to understand what the financial system actually is. Because most people interact with it every single day without ever thinking about it. It is the invisible infrastructure of money. When you get paid, that is the system. When you take out a loan, that is the system. When you tap your card at a coffee shop and payment clears in seconds, that is the system. It is built on 4 foundations. Banks, credit, payments, and monetary policy, the decisions central banks make about how much money exists and how expensive it is to borrow. This architecture was largely designed in the 1940s and 1950s. It was built for a world of paper, human judgment, and physical presence. And for 70 years, it worked. Slow. Inefficient. Full of bias and human error. But it worked. Then 3 things happened at once. Computing power became effectively free. Data became effectively unlimited. And AI went from a research experiment to a production-grade tool that outperforms humans at almost every analytical task finance requires. Suddenly, the entire justification for human decision-making in finance collapsed almost overnight. Why pay a loan officer 6 figures a year to assess creditworthiness? When an AI can process 10,000 variables in milliseconds and get it more right? Why employ a team of analysts to monitor risk when a model never sleeps, never gets emotional, and never misses a pattern in the data? The answer is, you do not. And the biggest players in finance figured that out fast. So what does the replacement actually look like? There are 4 areas where AI is not just improving the financial system, it is replacing it. Pillar 1, lending and credit decisions. For 100 years, your ability to borrow money depended on a human being looking at a simplified score, your credit rating, and making a judgment call. That model is being dismantled. AI lending platforms now analyze thousands of data points. Transaction history. Spending patterns. Income volatility. Even the time of day you apply for credit. The result is faster decisions, broader access to lending for underserved populations, and significantly lower default rates. The traditional credit score is starting to look like a blunt instrument from a different era. Pillar 2, payments and settlement. Every time you tap your card, a payment network is clearing that transaction. For decades, this was a slow, expensive process involving multiple intermediaries. AI has compressed this. Real-time fraud detection now flags anomalies in microseconds. Smart routing systems find the cheapest and fastest path for every transaction automatically. And AI-native payment platforms are starting to bypass traditional card networks entirely. Pillar 3, risk and compliance. Banks spend billions every year on compliance, monitoring transactions for fraud, money laundering, and regulatory breaches. AI handles this at a scale and accuracy humans cannot match. The entire compliance function of a mid-sized bank can now be largely automated. And it is. Thousands of jobs in this sector have quietly disappeared in the last 3 years. Pillar 4, Monetary Policy and Central Banking. This one is the most significant, and the least discussed. Central banks are beginning to use AI models to forecast inflation, model the impact of interest rate decisions, and manage the vast complexity of modern monetary systems. Several central banks are already piloting AI-assisted policy frameworks. The idea that monetary policy, the D. Here is the part of this story most people miss. They think the AI takeover of finance is coming. It is not coming. Large parts of it are already here. When you get an instant decision on a loan application, that is AI. When your bank flags a suspicious transaction before you even notice it, that is AI. When a fintech app offers you a savings rate your high street bank cannot match. Because they have a fraction of the overhead, that is AI making the economics work. Physical bank branches have closed at a rate of thousands per year across the US and Europe. Not because banks are struggling, because the human infrastructure they were built to support is no longer necessary. The jobs that built the middle-class financial sector for the last century. Loan officers, tellers, compliance analysts, risk managers, are being automated at a pace that has no historical precedent. And at the consumer end, most people have simply never noticed. Because AI does not announce itself. It just makes things faster and cheaper. And more accurate until the old way looks impossible to justify. But here is what the optimistic version of this story leaves out. Speed and efficiency are not the same as stability. A system that is entirely AI-driven is also a system that can fail entirely, instantly. In ways that no human could predict or prevent. The 2010 flash crash. Algorithmic spirals. Correlated model failures. These are not hypothetical risks. They are previews. So given all of this, what should you actually do with this information? 3 things. First, move your money where AI is working for you, not around you. AI-native financial platforms consistently offer better rates, lower fees, and faster service than legacy institutions whose cost base is built on infrastructure designed for a pre-digital world. If your bank still charges you for basic services that a fintech platform offers for free, that gap is AI efficiency being passed to consumers. Or not being passed. You choose which side of that you are on. Second, understand that your credit profile is about to get more complex. As AI lending replaces traditional credit scoring, the factors that determine your access to capital are expanding. How you manage cash flow, the stability of your income sources, your financial behavior over time. These things matter more than they ever did. Building a strong, consistent financial profile is not just about your credit score anymore. Third, stay informed about what is coming at the infrastructure level. Central bank digital currencies. AI-assisted monetary policy. The potential replacement of SWIFT with AI-native settlement networks. These are not abstract policy debates. They are structural changes to the plumbing of the financial system that will affect how money moves, how much it costs to borrow, and who controls access to financial services. You do not need to be an expert. But you need to be paying attention. The financial system has been the most stable infrastructure in human civilization for the last 100 years. It is now being rebuilt from the inside. Not by regulators. Not by governments. By machine intelligence that is faster, cheaper, and more accurate than any human institution ever was. Whether that is terrifying or exciting depends entirely on how prepared you are. Subscribe to WealthVerse. This is exactly the kind of shift we cover every single week. And in the next video, I am breaking down the 5 AI-native financial tools that are quietly making traditional banking obsolete. You will want to see that. See you there.